Again, you know what? It's super lucky on a day like today when we're all feeling a bit seasick from watching that euro-dollar move, especially this afternoon, that someone like Ashraf Laidi is with us today, Chief Global Strategist from Citi Index, very focused on these currency moves. Hi, Ashraf.
Hello, Lisa.
So all over the place this afternoon. I mean, trying to figure out what's going on in the markets is nuts.
Right. Just when you thought that the euro stopped rising in tandem with the stock market and falling in tandem with it, when we see such a big move in the stock market, the non-dollar currencies have no choice but to follow this. Regarding the stock market, this is very interesting. For the very first time this year, when we got the news to read the word taper QE, for the very first time this year, the Fed decided to say, hey, maybe we could taper. Maybe we could increase QE.
No, I love it. They did both.
200 economists at the Federal Reserve for them to say, we could do this or do that. Yeah. Combining the possibility that they could increase QE with today's a triple dose, which is not only we had the NFP much better than expected, the upward revisions were there, and the third one was the unemployment rate, which was the lowest since December 2008. Yeah. So you cannot argue with that. So basically, when we had such a triple plus, the dollar goes up and it drags the euro down, it drags everything down, but actually the biggest loser was the yen, right? But then when the stock market starts to break these key levels, 1600 in the S&P, 15,000 in the Dow, risk appetite continues or starts to command or to dictate the dynamics in the play and to try to be at the expense of the dollar.
It's really risk on. I mean, today at least. It's super risk on, despite the fact that we're still looking at these uncertainties in Europe. Right. I mean, we saw that yesterday, right? From the ECB, cutting by 25 basis points.
Very risk on. And what we told clients earlier this week, after the decision by the ECB, it was mainly basically aiming at the economy and not at stabilizing the market metrics. You know, the 10-year yields in Spain and in Italy were already at 3-year lows. The euro is quite stable. Euribor is quite stable. So the double cut that they had in the refi rate and in the lending rate basically was aimed at the soaring unemployment, the triple contraction in German the PMIs, and whether you argue with it, whether it makes a difference or not. So this is what that was aimed at. Yeah. The euro went up, but then, as you said, it came down because of the possibility that Draghi said they may have negative rates. If you ask me whether they are going to do it, I think it's just joe-boning.
Well, Ashraf, this type of stuff drives me nuts because I listened to the entire ECB press conference yesterday, and a journalist asked Draghi about whether or not they were ready for negative deposit rates. What's he supposed to say? No? You know, he's not. We discussed it on Closing Bell yesterday as well, where, look, we're probably over-interpreting a bit. You know, he's asked a question, so therefore he answers to the best of his abilities. Well, technically we're ready. Do you think it's been an over-interpretation?
Yes. Yeah. When the market wants to sell, it's going to latch on anything. The head of the central bank that is governing 17 nations, if they're going to ask him, are you ready for the discovery of another planet? He's not going to say no. In case interest rates go below zero, would you be ready? He's not going to say no. And not only he's not going to stop there, he's going to say, and we would carry out the suitable measures. The market took it as a rate, as going into negative rates. The interesting thing about the Novotny now, who is Austrian, the head of the Austrian bank, the Austrian banks have some problems. Austrian banks or any other bank that has cash and it's going to lend it to the ECB at negative interest rates, it is not handled to be taxed, because the negative interest rates by the banks is a de facto tax for them, so they have to charge. And so that helps explain that. So I'm glad that people like you who are trying to shed some light on first of all, the misinterpretation and then the excessive reaction. But it's very important to say what happened in the euro, the up and down, really encapsulates what's been happening in the last 5 weeks, which is going nowhere. And I do not expect the euro to go outside this 300 point or 350 point range above 132.50 or below 128. I don't really expect it because the tug of war in the dynamics in the negative and the positive between the doves and the hawks at the Fed. And between the issues that we are seeing in the Eurozone they are likely to keep the euro well supported or to prevent it from falling, and at the same time capped at 133.
Ashraf, you're with us for the rest of the hour. Very good thing as our guest host. Send your emails in. You must be curious about what's going on in the currency markets these days. You heard a little bit from Ashraf already. European closing bell at CNBC.com. That's the email address. You can also find us on Twitter. At Louisa Boyerson is where you can reach us. Ashraf is on Twitter as well at A Laidi. Is that right?
Yep.
Yeah. So you can find us both on Twitter.
Ira, this is Ashraf Laidi. What are the chances that your fox is going to end up transforming very slowly like the hedgehog? If you look at the ECB, they ended up being probably 3 to 6 months behind the Federal Reserves in terms of the stimulus and so on and so forth. So what do you think? They're going to have two foxes? I mean, sorry, two hedgehogs.
Well, well, I don't think that Draghi can possibly be a hedgehog. He's really fighting this against the Bundesbanks and the Germans about what is going to take place here. We see all over the world. This is an orchestrated to push the quote-unquote Austrians back, and that is taking place. But it's not quite so in Germany. You know, we're seeing some movement, but we've seen also the latest polls that I've looked at is that, of course, Merkel has slipped a little bit. And let's see, you know, we got a long summer to get through. I was kind of surprised how quiet May Day in Europe was this year, you know, considering everything that's going on.
Ira, I think you're giving too much attention to the Bundesbank when when the man of the year, your fox, was elected the man of the year. He was able to put the Bundesbank in the corner and able to declare the ability to do the OMT. He put them standing in the corner. And now the more likely that we're going to see disinflation than inflation, the Bundesbank is going to continue to be standing in the corner doing nothing, allowing for the fox to become like a hedgehog.
Well, you know, let's look at that. That's an interesting comment. You know, he announced OMT, but not one dime was ever spent on outright monetary transactions, nor can it ever be spent, because the Bundesbank was able to back Draghi into a corner and say, look, we'll sign on for this OMT, but it's based on severe conditionalities. So nobody has ever gotten one dime from OMT, and with the pushback against the Austrians, will they ever be able to? So Draghi's really in a difficult position. I agree with you wholeheartedly. How he gets out of this, but it's not going to be as a hedgehog, because he's prevented from that.
Because the Spaniards refused to play ball, not because the Germans went to the fox. Let's talk about it next week.
Well, but we're saying the same thing. The Spanish refused to play ball because they would fail to meet the conditionality test that Wiedemann had put forth. So he's not out of this yet, but you gotta give him his due. Draghi's been brilliant at balancing this out.
Guys, we've got to leave your foxiness and your hedgehogginess there. The sequel to be continued next week. Ira, thank you very much. Ira Harris, a partner from Praxis Trading. Ashraf, thank you to you as well. You're still with us for the rest of the hour. What do you Ashraf has been with us here for the full hour. You've been writing in galore with your questions. I'm going to just yell them out a bit quickly, and then we'll get to as many as possible. William writes, and he says, good evening, Louisa and guests. With the UK economy improving, will UK interest rates rise sooner rather than later? And if so, when will rates start to rise?
They will not rise. They will not normalize the stimulus, probably if they're going to do the QE. Mr. Carney is going to come in this summer. We may see the GDP improving a little bit, but no, they are not going to rise.
John writes in, and he says, could you please ask your co-host if he expects the dollar-yen to break through 100, and if so, can we expect it to push much higher from there?
We think we're going to go to 102. The next phase will be in July when Abe wins the upper house, and he will be able to do whatever he wants with the currency, and the technicals are very, very strong.
Technicals are strong for that to happen. Okay. We have some longer emails. I'm just going to save them for a moment. How on earth can $100 per barrel in light crude be positive for the markets? Asks at trader.
The chicken or the egg? Which one? If oil prices are up, maybe it's a sign of the demand or the use of demand. And as your guest on oil said, people have no choice but to have to continue to drive their cars. And so whether rising oil is a reflection of a rising market or improving economy or not, that is really the rationale. But it's very important. Guys, I don't know who asked the question. Check it out. Look at the chart. Gold to oil ratio. Important relationship with the stock market. Gold divided by oil goes down, the stock market goes up, and vice versa.
George writes in from Geneva, and he says, Bernanke-Draghi, they've said often that monetary policy is not the appropriate mechanism to solve the US or European problems. The problem is that fiscal policy has been so bad and that politicians refuse to take on the responsibility of helping their countries. He's paraphrasing a little bit. He says, why do most of your guests want to let the politicians off the hook and put the pressure on central bankers? The focus should be on government.
It's not about wanting. We can have coffee and we can talk about the right and the wrongs of the stimulus, but then you got to deal with the reality, okay? A country like the United States, where the sequestration is impacting the government spending, the PCE, the personal consumption expenditure, has to continue to play ball, but it cannot do so without rising asset markets. So we're not going to talk about the Austrian school or whatever the school it is. They have no choice but to maintain the stimulus. You have to get real. And stocks have not fallen more than 5% in many months.
I'm always real, I think. Robert tweets in and says, bull market, hallelujah moment, so on and so forth. Has the market learned nothing from the past regarding risk management? Pedal to the metal?
We can be sarcastic, we can be ironic and look at this and think, haven't we learned in 2000? Haven't we learned in 2007? Let's look at the technicals, the monthly technicals in the stock market. Right now, they don't look nowhere near as ugly. Actually, they look much better than how they looked in summer 2007 or in October 2007 or in February or March 2000. I may sound like I'm a big bull who is yelling buy, 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 but this is the reality. Come on, Louisa. We've heard many people saying the same thing in September 2012. The stock market is going to fall and so on and so forth. Where are they right now?
But why are we then seeing rate cuts? I still don't get it. Why do we continue to see rate cuts if we're not at that same fear factor level as we were in 07?
Inflation in the Eurozone went from 1.7 to 1.2%. That's the biggest drop in 33 months. The German machine, the PMI, went below 50 in their services and in the manufacturing. There is something called unemployment in Spain minus the 10-year yield on the bond. The lower the yield, which is the best it is. The higher the unemployment rate, it is bad. If you take unemployment rate in Spain minus the yield, we get a number like 23%. That's a very high number. That means the economy is worsening. But the market metrics, the courtesy of the stimulus, they are actually getting better. But what are you going to do? If you're going to take away just a little bit of that dosage, the worsening in the economy is going to accelerate.
Whew. I need to take this in for a minute. I'm glad it's Friday. I can think about this tonight over dinner. Thank you, Ashraf, for being with us. Are you doing anything this weekend? Anything fun? It's a long weekend.
Taking a rest and watching your show in the weekend. Ooh. And yeah, and then maybe we're going to look at the Derby and the other part of the puddle in the Kentucky Derby.
Excellent.
Yeah.
Very nice bit of Derby. Never heard anybody. Ashraf, thank you very much. Ashraf Laidi, Chief Global Strategist from Citi Index. Speaking of the show over the weekend.